Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Friday, May 19th, 2023. Relax, you made it. And welcome to the Crypto Overnighter, where we have no sponsors, no agenda, and no BS. Australia's stock market operator, the Australian Securities Exchange, has abandoned plans to rebuild its software platform using blockchain technology. The ASX has been working with the New York-based contractor Digital Asset to develop a blockchain-based trading, settlement, and clearing system. However, the project was put on hold in November of 2022 after an external review found that it would be too expensive and time-consuming to complete. In a meeting with participants on May 17, 2023, the ASX said that it would not pursue blockchain technology for its new software platform. Instead, the company said it would use more conventional technology to achieve its desired business outcomes. The ASX's decision to abandon blockchain technology is a significant setback for the industry. Blockchain is a promising technology that has the potential to revolutionize a wide range of industries, including the financial services industry. However, the ASX's decision suggests the technology is still not mature enough to be used in mission-critical applications. Australian-based crypto exchanges have lined up to extinguish fears of contagion after the payments provider for Binance Australia was told to offboard the exchange. As we talked about last night, Binance Australia told users that the Australian dollar services were suspended. This happened because Zepto, the payments provider, was told by its partner firm, Cuscal, to stop supporting the exchange. So, given the unbanking fears in the US and the UK, where crypto companies find themselves cut off from financial services, possibly at the behest of regulators who find choking fiat out of crypto might be easier than good old-fashioned prudent regulation. I'm sure you can see why Australian crypto holders might be nervous. The news sparked concerns that suspending Binance Australia's services could lead to a broader contagion in the Australian cryptocurrency market. However, executives from other Australian cryptocurrency exchanges said that they're confident that their businesses are not at risk. The CEO of Independent Reserve said that he does not believe that suspending Binance Australia's services is an industry-wide issue. He added that the Australian dollar deposits and withdrawals for his exchange remain uninterrupted. BTC Markets CEO Caroline Bowler said that she has no concerns about the health of her exchange. She added that BCT Markets works closely with its payments provider to prevent fraud and scams. Kraken Australia's managing director Jonathan Miller said that only a few payment providers in the Australian market are actually crypto-friendly, which probably doesn't help. He added that Kraken has a strong relationship with its payments provider and is confident that its business is not at risk. SwiftX's Chief Operating Officer Jason Titman said that his exchange works closely with Australian banks and law enforcement agencies to prevent fraud and scams. He added that SwiftX's withdrawals and deposits are performing as usual. The executives of the Australian crypto exchanges said that they are confident that their businesses are not at risk of the suspension of Binance Australia's services. However, they have said that they are monitoring the situation closely. For its part, Cuscal has hinted at the impact of scams and fraud related to account fraud, ID takeover, and crypto activity after being questioned about why it offboarded the exchange. Now, an official spokesperson representing Cuscal declined to elaborate why it specifically pulled support for Binance Australia. The official statement from the company makes no mention of Binance or crypto exchanges. They said, quote, "Following recent media attention in the relation to the impact of scams and fraud in Australia, with particular focus on account fraud, ID takeover, and crypto activity, Cuscal reiterates its commitment and important role in identifying and implementing detection services for our clients across the Australian payment system." The company said that it, quote, "has and will continue to terminate any clients or their customers and/or merchants that do not meet its onboarding and compliance requirements." The spokesperson told Cointelegraph that it's, quote, "focused on supporting the industry and protecting Australians from financial crimes and scams." Thank you so much for listening in tonight. As you might have heard, I want to start up some giveaways. So as soon as the YouTube channel has 100 subscribers, we'll start giving away a hardware wallet at $1 a month each month. So stay tuned for that. During a recent hearing of the House Financial Services Committee's Digital Assets Panel, there was a notable lack of consensus between Republicans and Democrats regarding the regulation of stablecoins. The primary point of contention revolves around the level of influence that state regulators should have. Representative French Hill is the subcommittee's chairman and a Republican from Arkansas. He supports a version of proposed legislation that grants more authority to state regulators. On the other hand, Representative Maxine Waters, a Democrat from California and the committee's ranking member, advocates for a Democratic proposal that grants a leading role to the Federal Reserve. Despite some optimistic remarks from both sides, there is a significant gap between their respective ideas. Representative Hill began the hearing by referencing a previous statement made by Maxine Waters, acknowledging that they were essentially starting over this year after coming close to reaching a compromise last year. Hill expressed during the hearing that they're not starting from scratch. He emphasized that there are strong similarities between the two proposals, suggesting that they're close in their positions. However, Waters countered by pointing out that the Republican language lacks several critical positions. Additionally, Representative Stephen Lynch, the top Democrat on the subcommittee, said that they have moved farther apart in their viewpoints. Now, there is a positive aspect for the cryptocurrency industry, which is eager for regulatory clarity in the U.S. Multiple congressional hearings have already taken place in recent weeks, indicating that the stablecoin issue and the broader crypto industry hold significant importance. Most members in both the House and the Senate are advocating for action. If they can reach a compromise on stablecoin regulation, it would mark a significant milestone in establishing U.S. oversight of the industry. Remember, any legislation related to this matter must still get through the Senate Banking Committee. Currently, Senator Sherrod Brown, the committee's chair and a Democrat from Ohio, has not displayed any intentions of being inclined to advance a bill on this topic. Now, while the debate rages on in Congress about the regulation of stablecoins, with no clear consensus in sight, it's not just stablecoins that are under the regulatory microscope. In a related development, the chair of the Commodity Futures Trading Commission, Rostin Behnam, has been focusing on another crucial aspect of the crypto world, decentralized finance. He was on Bloomberg's Odd Lots podcast when he said decentralized cryptocurrency exchanges would be subject to regulation. This regulation would be implemented by either the CFTC or the SEC. Benham emphasized the need to ensure oversight and compliance within the decentralized crypto space, highlighting the role of regulatory bodies in maintaining a stable and secure financial environment. Benham discussed the regulation of DeFi exchanges. He addressed the misconception that these exchanges, which can operate autonomously with minimal human involvement, are exempt from regulation. Benham emphasized that the absence of institutions or individuals behind the code does not make them immune to regulatory oversight. Instead, he highlighted the importance of considering the offerings and exposure of U.S. customers and identifying the individuals or groups responsible for setting up the entity and code behind the products. Benham expressed the CFTC's commitment to holding bad actors accountable in crypto. Now, during the conversation, Benham acknowledged that there is one specific area in which cryptocurrency will be subject to lighter regulation by the CFTC. This applies to markets where tokens function solely as a substitute for cash and do not represent any other form of asset. Benham clarified that the CFTC has no legal jurisdiction to regulate cash crypto markets. However, the Commission has limited authority to address cases of fraud or manipulation within the cash markets. He emphasized the importance of leveraging his authority to maintain integrity in the crypto space. The CFTC garnered attention in March by filing a lawsuit against Binance. This lawsuit claimed that Binance had conducted business in the United States without registering as a commodities exchange. Additionally, the CFTC accused Binance of neglecting to address instances of financial crime and money laundering that occurred on its platform. Binance, on the other hand, has denied the allegations. This is due to the inclusion of internal messages in which Binance executives allegedly acknowledge their involvement in illicit activities. Now, Benham expressed that nothing surprises him anymore, recognizing that some individuals deliberately evade or are unaware of the law. He highlighted the importance of deriving legal analysis from established legal precedents, explicitly referencing the Howey test. This test is used to determine if a contract involves a security. And Benham explained that the Howey test serves as the foundational framework for the CFTC's legal analysis of digital assets, shaping their understanding of whether these assets fall under the securities or commodities category. Benham acknowledged the existence of an unresolved legal area concerning cryptocurrencies. Specifically, he questioned whether a token, initially launched as a security with promises of future utility or value, could later transition to a commodity when it's traded on decentralized exchanges solely as a cash substitute. He recognized that while specific characteristics of digital financial assets align with traditional financial assets, unique aspects also necessitate distinct considerations and policy ideas for regulation. Benham emphasized the need for thoughtful analysis and policy development to address the regulatory challenges posed by cryptocurrencies effectively. Benham further elaborated on the complexities surrounding the classification of tokens. He explained that a new token might initially involve the pooling of capital to initiate a project, which could give it the appearance of a security. However, the situation becomes uncertain when the token transitions from being considered a security to being treated as a commodity due to decentralization. This shift from security to commodity due to decentralization raises important questions that are yet to be definitively answered. It highlights the need to explore further and examine the regulatory implications and considerations surrounding tokens in these cases. Benham emphasized the ongoing nature of these discussions and the importance of addressing these unique dynamics within the realm of decentralized crypto. And as regulatory bodies like the CFTC grapple with the complexities of overseeing the decentralized crypto space, real-world consequences of these uncertainties are coming to light. A prime example of this is the ongoing saga of FTX, a former major player in the crypto industry now embroiled in a contentious bankruptcy case. The team in charge of FTX's bankruptcy case is suing the former FTX CEO Sam Bankman-Fried, FTX co-founder Gary Wang, and former FTX senior executive Nishad Singh. They allege the acquisition of stock clearing platform Embed was significantly overpriced. Now, for reference, the sale took place just weeks before FTX's collapse. The current leadership of FTX claims that SBF and the other executives were aware of Alameda Research's insolvency when finalizing the $250 million deal. According to the lawsuit, Sam and the others used fraudulent funds from FTX customers for Alameda's acquisition of Embed. In addition to targeting former FTX Alameda leadership, separate suits seek to recover funds from Embed's founder and former CEO Michael Giles and early investors who sold their stakes to Bankman-Fried, including Propel Venture Partners. Giles and the Embed shareholders named in a parallel suit are not accused of criminal wrongdoing. Lawyers representing the failed FTX crypto empire aim to recover money by arguing that Alameda was already insolvent at the time of the deal and that an inflated price was paid for Embed. These lawsuits seek to maximize repayment to FTX and Alameda's creditors within the bankruptcy process. Apart from allegations of fraud and self-dealing, FTX's bankruptcy stewards accuse Bankman-Fried and his cohort of making a poor deal. FTX lawyers claim that the platform is nearly worthless compared to the amount paid for it. Internal messages in the filing show concerns about Embed's inability to handle new user accounts as planned. The filing states that Embed had around $37 million in assets and made a whopping $25,000 of profit as of March 31st, 2022. Furthermore, Embed's founder and CEO received a $55 million retaining bonus in separate installments, regardless of whether he stayed with the company or not. FTX's bankruptcy lawyers argue that there needed to be more due diligence done on Embed. So the terms proposed by Giles were accepted, resulting in an excessive purchase price and an unwarranted retention bonus. This retention bonus arrangement was considered unusual because it only tied the CEO to Embed until the deal's closure, without requiring him to continue running the company. As Embed's largest shareholder, Giles also received over $100 million for his equity. Now, communication between Embed employees included the lawsuit filing indicates the speed at which Alameda wanted to close the deal and the lack of due diligence involved. FTX lawyers state that their attempts to sell the company after the Embed acquisition failed to attract buyers at a price close to what Sam and the others paid. Giles himself submitted the highest bid of $1 million to buy back the company, but the bidding process revealed that $220 million paid by Sam's company for Embed was significantly inflated compared to its fair value. Now, while the FTX saga underscores the potential pitfalls and legal complexities in the crypto industry, lawmakers in Texas are taking proactive steps to ensure greater security for customers of cryptocurrency exchanges. In a move that could set a precedent for other states, the Texas Senate has approved a bill imposing stringent reserve requirements on crypto exchanges. This legislation could mandate exchanges to maintain reserves sufficient to fulfill all customer obligations. On May 15th, the bill passed a vote in the state Senate and now awaits the governor's signature. Known as Texas House Bill 1666, the legislation seeks to amend the Texan Finance Code and previously passed through the House of Representatives earlier this year. Throughout the 3 readings in the Senate, there have been no significant changes to the bill's text from the initial draft. The proposed amendments would impose specific requirements on digital asset providers operating in the state. Exchanges serving over 500 customers in Texas and holding at least $10 million of customer funds would be prohibited from commingling those funds with any other operational capital. Additionally, they would be restricted from utilizing customer funds for any transactions beyond the original demand by the customer. Furthermore, the bill stipulates that exchanges must maintain adequate reserves to accommodate all potential withdrawals at any given time. Companies would be required to submit a report to the Texas Department of Banking within 90 days after the conclusion of each fiscal year, detailing their existing liability to customers. Failure to comply with these regulations could mean license revocation. Texas has been a proactive jurisdiction in terms of cryptocurrency regulation. In addition to the Proof of Reserves bill, the Senate previously approved a measure in April to limit crypto mining incentives. Concurrently, the Texan lawmakers voted to amend the state's Bill of Rights, acknowledging the right of individuals to possess, retain, and utilize digital currencies. As Texas is taking strides to enhance the security of crypto exchanges, halfway across the globe, Nigeria is marking a milestone in its journey with digital currencies. The e-Naira, Nigeria's central bank digital currency, has completed its first year of operation, offering a unique perspective on the challenges and opportunities of implementing a CBDC in a developing economy. The International Monetary Fund has released a working paper evaluating its performance during this period. IMF researchers commended the e-Naira's debut last year, but also provided some suggestions for improvement. The e-Naira became the world's second CBDC after the Bahamian sand dollar when it was launched in October of 2021. The paper noted that the e-Naira's retail aspect was intermediated and faced no latency issues. However, it has yet to expand beyond its initial adopters. The Central Bank of Nigeria implemented a phased introduction. This delayed the achievement of 2 major objectives of the CBDC: extending financial inclusion to the unbanked population and facilitating remittances. The paper stated that breaking the initial low adoption barrier, similar to other network products like credit cards, requires a combination of clever strategies and luck. The analysis revealed that only around 1.5% of wallets were active weekly, and that total number of transactions during the examined period was just 802,000, which might sound like a lot, but it translates to less than 1 transaction per wallet, and less than 1% of bank accounts in Nigeria even have those wallets. Now, one key question raised in the paper is the relationship between the e-Naira and mobile money operators. Kind of a big deal given the extensive network of MMOs in the country. The e-Naira could either compete with MMOs in the retail market or act as a bridge to facilitate their operations. The paper acknowledged that completely replacing all MMO services with the e-Naira would be challenging and could lead to significant industry reshuffling. The IMF expressed concern about the parallel underground market that serves as remittances. As a single currency system, the e-Naira cannot directly accommodate remittances. The paper proposed 2 solutions. One, allowing international money transfer operators to receive e-Naira wallets, or 2, intermediaries. To enhance e-Naira adoption, the paper suggests utilizing the CBDC for social payments in collaboration with MMOs to improve the social cash transfer system and increase adoption. Merchants could be incentivized to accept the e-Naira, and while the Central Bank of Nigeria has taken steps to promote inclusivity through the e-Naira, remittances still need to be solved. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, maybe leave a rating or a review. And in the meantime, we'll see you tomorrow night.